we're trying to pick the right locations, the right properties that are going to outperform over the next 7 to 10 years. And we're finding some really good deals. Last year, we purchased 8 properties. It was $850 million in acquisitions. This year, we're off to a really fast start, but we're finding a lot of good opportunities. We're going to be in the $1.5 billion range on our acquisitions this year. We're not selling anything, though. We do not think it's the right time to sell, but we are trying to find any opportunities we can.
Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. We've got a real rock star here today. His name is Jeff Gleiberman, and he's the president of MG Properties, and they are in 28,000 units in 6 states in very big metro areas. And we're going to have a wide-ranging and I'm sure incredibly interesting conversation today. Welcome to the show, man.
Thank you for having me. Great to be here.
Absolutely. Well, listen, you started to tell me a little bit about your family history and really how this company of yours grew to where it's at, but I'd like you to do it all over again. So if you kind of give your, why real estate, why, how your company became a powerhouse in this business, and just kind of give us a little bit of a bio. Much better job than I did, please.
Yeah, I'm happy to do it. And very blessed to be working in a family business founded by my father in 1992. Wow. He was a tax accountant in the 80s, saw lots of tax advantages to real estate, a lot of wealth potential, and felt that people always need a place to live. So he wanted to focus on housing. The first partnership we purchased was in our hometown in San Diego. It was 38 units in North San Diego. It had both my grandparents in it and 2 of my dad's friends. Did very well, and we started putting together more and more partnerships throughout the 90s in San Diego. And then we expanded to new markets starting in 2000, all over California, up into Oregon, Washington, Arizona, Nevada, and Colorado. So today we have just over 29,000 units. It is in 6 states, and we have modeled almost every deal just as they've all been the same model, and just looking for well-located, well-built properties. We do our own in-house property management, asset management, construction management, over 900 employees now. That keeps us very busy, and we're seeing a lot of good opportunities today. So happy to discuss any details there.
Well, you answered some of the questions I was going to ask, actually, if you were vertically integrated in all these states. Wow. So is it MG Properties Property Management then? Is that it?
Yep. Anyone that works at our properties works for MG Properties.
Okay.
We really feel that that's been a huge key to our success in the Great Recession in 2007-8, during COVID, being able to pivot, having the right people at the right properties, and having full control over everything that happens at our properties.
Yeah. No, that's absolutely the way to do it. We're not to that point yet in my portfolio, but no, that the certainly the more successful operators, the larger operators, all vertically integrate in every piece. So you have the whole construction component as well. You go in and do your own make-readies, do your own CapEx.
Correct.
Projects.
Yeah. Full construction team, and it's been that way since day one. When my father started the business, he was everything. So it was just out of our house. When we did that first deal, he was doing leasing, maintenance, management. Then when I was young, I worked at the properties doing leasing and management and maintenance growing up. Same with my other 2 siblings who are not in the business anymore. But then worked through after college, went to CBRE for 3 years, went back and got my master's. And now I've been back at the corporate office for about 10, 11 years.
Were you in sales at CBRE?
I was doing, they had a...
Cold calling owners?
I was doing investment sales for Multifamily in San Diego and the Inland Empire, which is San Bernardino, Riverside County in Southern California.
Yeah, so CBRE, if you don't know, is a huge real estate brokerage, kind of like Marcus and Millichap, Newmark, Grubb and Ellis. And so you were there pounding the pound. Wow, you've done it all. Yep. Which is fantastic, because that allows you to effectively not just manage, but you know what's going on. You know if something's off because you've done it all.
No, I learned a lot working at a big organization like that, made a lot of connections, and really, really happy I took that path.
Well, that probably was the greatest experience for the role you're in right now. But I'm just talking about all the way, from doing the maintenance to doing the leasing to doing all these little pieces that, a lot of leadership people haven't done, so they don't really fully understand the nuances. And you've done it, so that's hugely valuable when you're running a company and you've done the different pieces. Would you agree?
Yeah, no, definitely. One quick story on that side. Yeah. When I was very young, probably 8 or 9, Mark, my father, was doing everything, and the weekends were for acquisitions because he was running the properties during the weeks. So he would take me to possible acquisition tours on the weekends.
Nice.
If we purchased a property, I would get a $5 commission plus 10 cents per every unit. And I remember the first commission I got, 48 unit deal in Oceanside, North San Diego. I got $9.80, but I still remember it. And he tells me, by the end, I would only want to go to the properties that had the most units. So gets you thinking at a young age.
Oh, that's funny. That's awesome. Well, that's awesome that he involved you that early on and built your passion for the business, because obviously, as you know, when you love what you do, work is play, and you're passionate, and that passion allows you to influence people because they can see you love what it is you're doing. So, wow, incredible. So, I started to tell you a little bit about some of the debacle that I'm in right now, and there's a lot of upset in the market right now. We're seeing a lot of multifamily operators that got into bridge debt and things like that. How are you aligned in that way? Have you got much of that, or is it all long-term conforming?
So we've really modeled all of our deals the same since day one. We do long-term fixed rate financing, usually 7 or 10 year with Freddie and Fannie, interest only at around 55% LTV. So the portfolio is very well protected. In some cases, we will put on a variable or a bridge loan if we're doing a big renovation, if we're cleaning up delinquency. So of the roughly 102 properties we have, 2 had variable rate loans on them. We're working to restructure those into fixed rate loans because as everyone knows, the variable is very, very troubled right now.
Right. So, but that's what's causing what's happening in this. In the multifamily sector right now.
Yeah, we're going to see a lot of lot of distress coming here soon, and worse. But yeah, so very, very well protected. 98+% of our portfolio is fixed rate financing. The average in place rate on the financing we have is 3.6%, which is just
beautiful.
Yeah, feels very, very good.
Beautiful, beautiful, beautiful. Well, I think the Fed just said they anticipate coming back 2 points. I think I just saw that, so which would bring it back, in the, what is that, the 4 range, 3 range. But yeah, I mean, there's a lot of pain right now. We won't even talk about office. I'd love to get your opinion on your crystal ball for really the country economically as a whole, and give you my opinion, but I'd like to hear yours first, and really our asset class, multifamily, moving forward. So yes, please.
Yeah, it sounds good. And we only purchase existing multifamily. We don't do any development.
Same.
Everything's stabilized, and we're pretty excited about some of the purchases that we're doing today, just with the basis and the price that we're paying, and then the long-term view on the development pipeline. In the short term, the development pipeline
absolutely, no question, because it's pretty much been cut off, and so that means, please, I'm stealing your thunder. Please continue.
Yeah, no problem at all. Yeah, so starting after 2026. Almost no new development will be delivered. And so since we're 7 to 10 year holders, we're trying to pick the right locations, the right properties that are going to outperform over the next 7 to 10 years. And we're finding some really good deals. Last year we purchased 8 properties. It was $850 million in acquisitions. This year we're off to a really fast start, but we're finding a lot of good opportunities. We're going to be in the $1.5 billion range on our acquisitions this year. We're not selling anything, though. We do not think it's the right time to sell, but we are trying to find any opportunities we can.
Yeah, no, that's and you and I are in the same camp in that regard. We just closed on a deal at about a 40% discount, which I call it a unicorn. I assumed some existing debt at 4%, and we're starting to see the deals, and it's funny, and I'm sure you've seen this as well. For up to about a year ago, you'd see a handful of deals, you'd see some deals, but I mean, it's like every day I'm seeing 5 to 10 deals hit my email, and from what I understand, sales are down about 90% right now. So, the proverbial, I think is getting close to hitting the fan here. But how do you feel about the country economically as it relates to where we are now and where we're headed? Any thoughts there? I know it's crystal ball stuff, but I'm just curious.
Yeah, there's definitely a lot of volatility out there and a lot to take in. It's an election year, and the economy is still running really hot. Unemployment numbers are good.
Right.
We're strictly monitoring the multifamily market, so we're trying to get extra granular and really look at submarkets over markets. So we're in major metros on the West Coast, and we're targeting certain submarkets that have the least amount of new development, but that have the most amount of access to jobs.
Right.
And so we're really trying to pick these specific submarkets, hold these properties, manage them, run them ourselves, and then over the next 7 to 10 years have outsized returns. And we'd much rather over deliver than over promise.
Yeah, well, of course. When you're talking to investors, the key is to under promise. So these submarkets, are they part of these major metros that you told me before we started recording?
Yes.
You're in Denver, Phoenix, I think you said
Portland, Seattle, Reno, Vegas. Yeah. California is where we're from, and we know it well. It has its risks, with rent control and some political risks, but we still love the market long term. Very, very hard to develop. Right. Still very good quality of life, tons of jobs, dynamic job base. So we're all over California, but really looking at specific submarkets. I mentioned the Inland Empire earlier today, which is the inland areas of Orange County, San Diego, and LA. Love that market as well. Lots of industrial jobs, very little new development. We're big owners out there. And in certain, we'll find like a Phoenix and find a specific submarket that we're targeting. We really like Chandler, Ahwatukee, Mesa, and then try to find properties at a discount to replacement cost today. And we're finding some good ones.
Yeah. So, I get a lot of listeners that have not pulled the trigger on this business yet, either passively or actively, more actively, honestly. And they're people that are in a W-2 job that know they want more out of life for themselves and their families. And I teach this stuff. I don't know if you knew that or not. I do boot camps regularly, virtual and live boot camps, and have about 1,400 coaching students around the country that own hundreds of thousands of units. And so I attract people that want to do more with their lives. Speak to those people for me, if you would. The ones that know they need to do something. I mean, obviously you're at the pinnacle of this, but pretend you're, at a W-2 job. You're not thrilled with that job, and you want to improve your lot in life. Give them some words of encouragement, if you would.
Yeah, there's a lot of opportunity in real estate and creating passive, tax-efficient income. Yeah. And you can do it with great sponsors, with general partners. You can do it on your own. Right. Doing it on your own, you're usually starting with smaller properties, which could be good and bad. There's mom and pop operators. You might find some more upside. There could be some really, really good deals that you find. And then if you find a good operator, they have some economies of scale. They typically get some better insurance, some better loans. So that could be the right path. But with some of the tax advantages to passive income, it has been a life-changing part of many, many of our LPs' portfolio. Our LP group has grown word of mouth from 4 partners in the first deal to over 2,000 partners now. And I am very blessed to hear a lot of great stories about how it changed their life and how the income is, so valuable to them. And so it is a big, important part to many of our LPs' portfolio.
No, that's great. And, I know that like we said, you focus on these major metros, which, in our business, he mentioned jobs, by the way. Jobs is the most important factor in the multifamily business. Would you agree?
Yes. Yeah.
And I'm assuming you're primarily in A and B assets. Is that correct?
Yeah. We try to stay B to B plus is really
B to B plus. Yeah, that's a good sweet spot.
Yeah.
Because I have a couple of C assets that were purchased with my ex-partner, and I think that demographic is going to be more and more challenged. I mean, I'm recently single, so I'm going to the grocery store and I'm seeing what stuff is costing. I'm like, holy crap, how do people afford this? Or filling up your car, for example. And I think that paycheck to paycheck demographic is struggling already, let alone, what could be coming. So would you agree with that, or what are your thoughts?
I would agree with that. And I'd also add that at different times in the cycle, there's different opportunities. And we've been in the business now for over 33 years and seen many cycles. We've never had any losses. Every property's had a positive return. Mm-hmm. Coming out of recessions or out of downturns, there's a lot of opportunity in the C space, maybe in the B minus space.
Good point.
So we were buying a lot of C, more B minus coming in 2009, 10, 11, 12. Mm-hmm. Then as the cycle matures, the C product becomes very similarly priced to the B and A. And we feel that it's better to buy the newer, nicer, better located. So right now we're more focused on what we call core plus, which is deals that are 10 years or newer. But we've done many, many deals that are 30, 40 years old, big value add projects as well. Over our history, 50% of our deals have been kind of value add deals, and then 50% have been core plus newer. But at different times in the cycle, there's different opportunities, and those C opportunities will come back again. It might be a little bit another year or two, but they're definitely
that's when back. I believe it'll be there, like next year to end of next year. How do you feel about the impact of the election results?
Historically, it hasn't impacted us very much. We looked back and we really haven't seen that big of an impact, just looking back at the last 30 years of our company. But it does impact policies that could impact interest rates, which is obviously a huge topic right now.
Right.
10-year went down this week with the inflation news close to 4.2. And with spreads in the 150 basis points rate, we're getting all in 10-year loans at under 6%, which really is not that bad.
Let me give you some context. Okay. When I got in the business in 1978, the rates were 18%. And I remember doing backflips when they hit 7%. And I'm sure your father remembers this as well. And we're like, holy crap, it's 77%. And so just to give some context to those of you listening that are freaking out about it, this number is empirical. This business is empirical. It's just numbers. And we made deals work in 78 and 79, but it's just, different purchases, different purchase prices and different deal structure. But but I will tell you, it's hurting a lot of operators. We've looked at deals where the reserve payments, we looked at a deal in San Antonio, the reserve payments for this seller went from $8,000 a month to $80,000 a month. That's a big hit. I talked to a lot of operators. Luckily, I'm blessed in my coaching program. We've only seen one deal go south so far. And I shouldn't say so far, just one deal go south out of, a couple of 100,000 plus units. But so you don't invest in any other asset classes, just multifamily. How long have you been at the head of the company? I'm just curious.
When I came back full-time about 11 years ago to the corporate office, I did a couple years in each department doing some property management, some asset management, acquisitions, investments. And then just right before COVID, so probably 3 to 4 years ago, took back over as president, taking a much bigger strategic role, trying to free up Mark's time to do what he likes the most, which is really analyze and look at the deal structures and look at our portfolio.
So he's still active as well.
Yeah.
That's
so
cool.
I'm very, very lucky. I get to work with my father every day.
That's nice.
And he's our CEO and founder, loves the business, and we really love what we do.
Yeah, no, that's awesome. So, everybody thinks it's all roses in our business, that it always goes perfectly. Talk about, I call them seminars. By the way, I lost $50 million in 2008. I don't know if you knew that or not. Yeah, I got completely destroyed. I call them seminars when that happens. It was a big seminar, but talk about any setbacks you've had or seminars that you've had, and maybe think of a doozy that you can share and maybe the lessons learned in an acquisition or a turnaround or whatever.
Yeah, that 2008 Great Recession was very significant.
Yeah.
And especially in, certain markets where
California got creamed. So did Florida. So did Nevada, Arizona, right?
Yeah. For our markets, when we were operating, Arizona was the hardest hit for us. Just so many homes were being built. And then overnight, those homes turned to rentals, which were direct competition. All those home building jobs went away. So we lost lots of jobs. And we bought a deal, 2007. It was the lowest performing deal in our history in Tucson. And we had to do a workout with the lender. We held through, managed it correctly, focused a lot of time on it. It ended up to be a 4% return per year, which is our lowest returning deal, but full capital recovery and a small return. So very, very big win in the end, but just a tough ride for a couple years there. It was a big recession.
Yeah, and it took a lot of your time to deal with it, right? Yeah. How many deals have you gone full cycle on? By the way, guys, full cycle means buy and sell. How many deals have you gone full cycle on?
100.
100, no kidding.
Yeah, we've done 100,
wow.
and so we've purchased just over 200 deals in our history. Right now, we're holding about 102 of them, and right around 100 we've sold. So nice. It's been the average hold period has been right around 7 years.
Okay. Yeah, I had to deal with a horrible property in Shreveport, Louisiana, 403 units. Ex-partner got me involved in it. Got my ex-partner involved in it, and this guy we knew got us in it, and he had a management company. He's ran it into the ground. When I took it over 8 months in, the pools were green. It was grossing less than $100,000 a month, 403 doors. I literally had to live there to turn it around and got it up to over 300, and thank God we sold it. And I just found out literally a month ago, the city shut the utilities off and everybody moved. Everybody had to move. I mean, it died again. So yeah, that's my seminar in the business. But besides your father, did you have any other mentors? Did you have any like outside mentors, or was it all pretty much in-house with your family?
Mostly in-house with my family, but at CBRE, my first boss and mentor really helped me a lot in the business, and I learned a lot there. But my whole life, I just always knew this is what I wanted to do. Found it super interesting and loved the business. We got lucky that we were in a great business that thrived for 35 years, and we still think it's going to continue to do that for the next 30 years. So
it's a huge housing shortage in this country, and there's a big disparity between being able to purchase versus rent. So I mean, we're pretty much becoming a renter nation. Would you agree?
Yeah, we're seeing it's the biggest difference between buying and renting today.
Right.
And there's a different mentality too, where renting is easier for many people. Right. You can pick up and move, you can call and get something fixed. You have all the amenities right there. People are used to it. They're doing it much longer. Couples are having kids later, getting married later. So we're just seeing a lot of trends and demographics that are very, very positive for renting. And we believe it's a very, very good time to buy.
Yeah, agreed. The reason my podcast has been so successful is I spend a lot of time talking about mindset and psychology, and how really 80 to 90% of a person's success in anything is just that, their mindset and psychology. Only 10 to 20% is the real estate mechanics or business mechanics or whatever. What gets you to jump out of bed in the morning? What's your why? What makes you be the driver that you are?
I think just being in this business for so long and just having different stakeholders that we benefit so much really drives me. Mm-hmm. So our biggest stakeholders we've talked about today are our investors, which obviously very, very important, but we have many other ones as well. So we've got over 900 employees giving all those jobs. We do a big leadership conference every year. We bring in all the managers, the maintenance supervisors. We get about 350 people just kicking off the year with our goals and our mission. And I just love being there and helping lead that. And then also our residents. We've got tens and tens of thousands of residents providing safe, affordable homes and amenities. It's really, really rewarding, and it keeps me going.
Nice. You know, you know who you sound like. I've had Albert McKinney. Do you know Albert? I'm not Albert McKinney. I'm sorry, Albert Beres, McKinley Corporation. Do you know Albert Beres?
Heard the name, but
yeah, I'm huge, like 40,000 doors, and his company was actually featured in the book Traction. I don't know if you use an EOS or any sort of a system like that, business management system. Do you use that?
Not that one. But
you're familiar with it though?
We use a few different ones.
Do you? Okay. Yeah. Well, anyway, you know, just the way you talk about, you know, your stakeholders, your investors, your employees, and he's you know, along the same lines, and yeah, I don't know why I digressed with that, but it just triggered that with me.
The employees are so important. And
it's everything. Yeah. Your business is nothing but systems and people.
Yeah.
You get the systems right, and you get the right people, success is inevitable. Would you agree with that?
Yeah, and on our executive team, most of them have been with us for over 15 years. We've got team members that have been with us for over 20, 25 years.
That's cool.
And it's just so rewarding.
That's
to
like
see.
Family.
Yeah. And they teach us so much, and the dedication that they show to our business and to all our stakeholders is really amazing.
Yeah. And you know, guys, I hope you're getting the clues here, because like I said, I mentioned Albert Beres, who's been on the show a couple of times, and he speaks exactly the same way. And there's a reason that these guys are so super successful, is because they focus on the people that matter. They treat them well, they take care of them, they validate them, they encourage them, and they listen to them. Would you agree with all that?
Yep. Yeah. And put them in a position to succeed.
Yeah.
You really got to use people's strengths,
right,
and help them improve on places that they might be able to improve.
Yeah. You know, I mentioned the book Traction, which I don't get anything for talking about this. We use that in my organizations, and it's called Entrepreneur's Operating System. A guy named Gino Wickman wrote the book, but it's just about, you know, some of the things we're talking about, where you identify what people need to go on, what butts in the seats. And then, like, for example, instead of an organizational chart, you have an accountability chart. And I'm sure, like I say, in an organization your size, you've got, you know, different methodologies you use to stay on top of what's most important. In that organizational system, you do 90-day goals, and you have your leadership team do 90-day goals, so you stay focused, which has really been helpful in my companies. But in your role, what has been the most challenging part of your role for you?
A recent challenge that we've seen is on the on-site hiring. So corporate office, we have 130 people, and it's been very smooth, and we've got great systems, policies, and feel very good about it. But just on the on-site, a lot of turnover, and just trying to keep people motivated and working towards a common goal has been very difficult.
Same here. Exact same thing. You know, I told you about the fact that I'm taking over some assets, and that's been the biggest hurdle for us as well, is finding good people. I wonder why that is. Do you have any idea why that might be?
I think it's just a really strong job market, and people are seeing other opportunities that maybe are paying a little bit more, and maybe the grass is greener, trying new things. Obviously, the disruption of COVID changed the whole workplace with work from home. And in the apartment industry, you can't work from home if you're working at an apartment. So that loses a lot of people right there. You need to be on site for our on-site employees, obviously.
Right.
So that changed a lot. And just we're starting to see a little bit more improvement the last couple months, and I think we're on the right track, but it's been a difficult few years.
Any strategies that you've implemented as a result of this issue?
Really trying to drill in, you know, our family business feel, even though we're kind of an institutional business now, of, you know, more than just a number, and really include you in the success of the property, include you in our future goals, in our planning for the property, and just trying to make people feel really a part of the team.
That's great advice. You know, one of the things I did for one of my companies was I did this future vision, and it was geared towards new employees. Now, I haven't done it in years now, but I in fact, it's probably still on my website, actually dated on my website, but people like to be able to see themselves in a future that's compelling and with an organization that cares about them and all that. And, that's really good. I asked that question for my own edification because we're dealing with that right now ourselves. But let me ask you this question. I like to ask sometimes, if you could go back and tell 18-year-old Jeff something, knowing what you know now about this business, about life in general, take it anywhere you want. Is there anything you might do differently or anything that you would maybe double down on, or take it anywhere you like with that?
The first thing that comes to mind is to stay disciplined. I feel that we are almost disciplined to a fault. We have all 200 deals we've done have been almost identical, structured similarly, they look the same. But now looking back, that has been the key to our success. We fully understand what we do. We aren't taking unnecessary risks. We can manage through anything that the economy or that the cycle is going to give us. And that discipline has been key to our success.
Okay. So nothing different.
Something that I would do different. Let me think about that for a second. We've been talking mostly on the LP side, on the private high net worth syndication model. We also do institutional deals as well.
Oh, you do with private equity?
Yeah, with private equity. And that started about 10 years ago.
Wow.
And it was a big change for the company, just the reporting, the amount of work that goes into each one of those deals. And
controls that they exert sometimes as well, yes?
The controls for sure.
Yeah.
They can sell when they want, even if we don't think it's a good time.
Right.
If they don't approve certain CapEx things that we think need to happen at the property. So I would have been a little bit better prepared for the amount of work that brought to our business and the amount of change and time that went into that for our business. On the flip side, it helped our business grow significantly. So
because you're able to do larger deals, or
we were able to do larger deals, raise more capital. It opened up new opportunities and relationships with institutions that were selling deals. It is so important today that your reputation of who you know, to get a final look at a deal, to buy a deal. So we had about 12,000 units when I came back full-time 10 to 11 years ago. And now we're at close to 30,000. So that really helped grow our business, but it changed our business too.
Got it. Oh, that's very valuable advice. I'm sure you have people come up to you and say, okay, give me the magic pill. How do I do what you're doing? What can I do to get into the business? And they're more asking on an operational level rather than a passive level. Is there a book or anything you give them, or is there, what book would you gift the most, or any tools or strategies that you share with people that come to you wanting to learn?
Yeah, Investing in Private Equity Real Estate by Sean Cook.
Oh,
yeah.
Okay.
Yeah, it is a very, very well written overview on just general real estate investing. Someone I know wrote it very well, and I usually don't say this out loud, but he doesn't like to know too much. But our CIO, Paul Caseberg, who I've worked with for over 15 years, wrote an amazing book about real estate investment. He didn't want it to have anything to do with our company, so he put it under a different name. But you could check it out. I think it's very well written, really, really good overview of the business. I like some of the Tony Robbins kind of just general investment books too. Money Mastery. He just
came out with a new one that he's been pushing. I forgot the name of it, but I spent 20 years with Tony, by the way. I was on his team for 8 years, and that's really where I got all the mindset.
Yeah, I think he's really just an amazing, super gifted person, and just the concepts that he has are just so helpful to people, and just those are some of the great books. Those are
good. Those are very good. So, in this day and age, we've got cost segregation, we've got bonus depreciation. In the past, we've had 1031 exchanges. Give me your insights on those tax strategies that are just so incredible right now.
And this goes back to the very beginning of our business. So Mark was a CPA and tax CPA in the 80s, and he saw these tax benefits and really wanted to build our business around this. So every time we sell a property, we do a 1031 exchange. We've done hundreds of them. Also, we have been doing exchanges from outside parties as well, where they can come in as a tenant in common, and that's been really valuable. And then on the cost segregation side,
before you move on, by the way, so guys, what he blew through that kind of fast for some of you that don't understand the business. So let's say Jeff or I are raising money for a syndication, and somebody comes to us. It has to be enough of a chunk to be worthwhile, because a tenants in common deal is complex and there's more legal involved and there's some complexities. But someone can take their money that they sold, that's the gain from an asset that they sold, and put it into your syndication, and it's called a TIC, or a tenants in common deal, and step in to one of your raises, basically, when you raise money for these deals. I don't know if I described that perfectly accurate, but if I didn't, please correct me.
That sounds good. The 1031 exchange, selling real estate, and then there's a certain amount of time before you can invest in other like kind real estate, which means income real estate. And that's been the biggest wealth kind of growth for our investors. It's just been so valuable. And then on that outside 1031 exchange that you mentioned, the structure that you create to invest is called the tenant in common. And as you mentioned, it does take a lot of time and a lot of extra work. So where our typical minimum is $100,000 for just a normal new cash investment, we do a $3 million for
$3 million. Yeah, mine's $1 million for a tick, but you're doing much larger deals than we are. Okay.
Yeah, exactly.
Okay. And what you just described, when you sell an asset and your investors roll it into another asset, obviously, they kick the gain down the curb. Do you do any cost seg or bonus depreciation? Do you do all that as well, or no?
We do, yeah. So every deal, try to get as much upfront depreciation as possible.
Right.
That helps, make all the income, passive income, tax deferred.
Right.
And it's really, really valuable.
Oh, it's incredibly powerful. Did they approve the 100% again, or is it? I think it's still in still in legislation.
Yeah, they're still figuring it out.
I mean, they've said they're going to do it, but we know how long it takes to get anything done in this country. So, shifting gears just a little bit, I'm not super thrilled with our education system in this country, and I was just curious what your opinion was. If you could teach school children one thing on a weekly basis, what might you incorporate, knowing what you know about business and life and everything else?
I don't know if I've had the exact same experience that you've had. I've got 3 young kids, 3 under 8.
Wow.
And I've been happy with their education.
Have you? Okay.
Yeah. So
so we disagree on that one.
Yeah.
That's
so
fine.
Fair
enough.
And I'm sure there's some things
they go to public school.
They go private.
Private. Okay. Yeah. Okay.
Yeah, I don't know if that.
Maybe that's.
I went to public and I loved it.
Well, I loved the extracurricular part of public. I didn't love the education piece at all. I felt like I really didn't get any. I look at some of the things in my view, and just give you my opinion, that are lacking is like emotional management, entrepreneurship to the level that I think it could be done. Financial, understanding of finance and investing and so on and so forth. So I think that stuff, now maybe that's improved since I went to school. I'm 64. It's very likely it has, but I wasn't impressed with it when I did. So that's my 2 cents.
I think it's slightly improved, but those 3 topics that you just mentioned are super valuable and would be amazing if the kids are being taught that.
Yeah. So you lead a very large organization as the president. 900 employees is big, and you talked about you pull everybody in, 350 people in for a leadership conference. What do you think are some of the most important traits that a leader should have?
Dedication to the business. Well, that kind of brings me back to our company values. So we sat down 10 years ago, really wanted to think about our company values for all of our employees, and for myself as a leader. And we came up with DRIVE, which is dedication, respect, integrity, value, and empathy. And these are things that we want to live every day. And if we do that, that's going to help motivate our team members and our employees. and keeping people in the know. We want to have as many communications with the whole team so they know company visions. We do twice a year strategy meetings, set goals for a 1 year, 5 year, and 10-year plan, and really be able to involve everyone in the company.
And you hammer those core values home when you hire someone and at all your meetings, correct?
Yep, it's all around the corporate office.
Yeah.
It's at the big corporate leadership meeting that I mentioned. It's something that we talk about and that we live every day.
Nice. Our acronym is family, and of course integrity was number one, but we had to kind of put it in the down the chain a little bit just to make it work with the acronym. But yeah, love it. So those are your core values. How would you describe your leadership style?
Transparent and direct. So we have certain goals. As I mentioned, we're kind of disciplined to a fault. So we do a very similar thing every year, but we want to be very specific about our plan and about our goals. So this year we won't be selling any assets. We just do not think it's the right time.
No, definitely not the right time. Right.
So we told the company that's the plan, but to keep your ears and eyes open for any opportunities. And this even starts on the on-site. We wanted to let them know too, because if they see people touring properties, if they hear about properties that might come for sale, properties that might be having some distress, that might get us the head start to get the opportunity to purchase something that's a really great opportunity. So even starting from on-site employees, letting them know the long-term plans. We do a profit share program where everyone gets a bonus if we hit certain metrics, if we hit our controllable NOI, if we hit our acquisition bonuses, if we hit
just corporate or the entire company?
Entire company.
No, that's awesome.
Yeah, so really trying to keep everyone involved and have the vision all together.
No, that's fantastic. What do you think is, I'm sure you agree with this, that what we do is a team sport. It's not something you go do by yourself. I mean, there are several different hats that can be worn here. I mean, I know your dad started it by yourself, but I'm talking when you're buying 100 unit plus complexes, it's a team sport. What do you think is your superpower as it relates to this business? Where do you think you fit in the best?
One of the biggest things I've added to the business is relationships and the importance of relationships. Always doing what we say, only committing to deals that we're going to get done. If we go into a deal, we know we're going to get the debt, we know we're going to get the equity, we're going to do things on time, we're going to work in good faith to work through PSA issues. And
purchase and sale agreement, the contract is okay. Keep going.
Yep, exactly. Yeah. And many of our deals have been from repeat sellers and repeat buyers. And we want to
and repeat brokers, I'm sure as well. Yes.
Yeah. And so we can always get the heads up, and really the relationship part of the business has been something that I've wanted to add and has been very, very valuable.
If you could give one of your most valuable pieces of advice that you've either heard or you believe to my listeners, what might it be?
We've focused on it a little bit today.
Okay.
But that discipline has been so important to our business, and I think it can really help many listeners out there. A lot of the trouble that we've seen throughout the last couple cycles is people adventuring into things they don't really know, and there's plenty of good opportunities out there. So you can definitely have more than one focus, but if you spend the time to really analyze, understand what you're doing, and also having interest in each deal. So having that co-invest or that skin in the game.
Yeah, we talked about that. How there are a lot of GPs that have done deals over the last few years and they really don't have any of their own money in. Speak to that.
Yeah, that really changes the mentality on what kind of deals you're going to buy and do. Mm-hmm. So at a minimum, we would like to see a 5% co-invest in any deal that we're looking at, just so people really are understanding the deal, have skin in the game.
Where you're putting 5% in the deal is what you're saying. Yeah, we do 10% ideally whenever we do one, but we're in smaller numbers than you are.
No, we do. Our internal company policy is 10%.
10% as well,
but just for other companies, if it's lower than 5, it just seems like the interest could be misaligned. So that is something that is really important if you're starting your own business, putting your own skin in the game, analyzing it that way. If you're investing with other companies, looking for the co-invest, making sure that it's, from the main GP or the main principal.
Yep, agreed. Jeff, when you talked about looking, and I'm circling back here, Brian, you may cut this in, you may not cut it in, but when you're looking at a market, like you're looking at some of these sub-markets, what do your analysts or you or Mark look for as the fundamentals in that market? And what sort of things do you need to be seeing when you're looking at a market that maybe you haven't invested in before?
Yeah, so obviously we're in 6 states, which we didn't start in 6 states.
Right.
So as time has gone on and we've seen more and more good opportunities in this space, we wanted to grow our markets for a few reasons. The main reason is diversification. Right. With diversification, you never know which market's going to do the best. Nevada or Arizona, a little more business friendly.
Right.
California, Oregon, or Washington, a little bit harder on the businesses. So we want to have diversification. But on the investments team, we've got 10 full-time professionals, and they each have a market that they analyze, and they have analysts. And we want to look at a market for usually 4 to 5 years before we enter into that market, understanding all the job patterns, where the best school districts are, everything about the market, down to that sub-market level that I spoke about earlier. So we are looking at new markets for the future, and we want to continue to grow our business. We have been looking at Atlanta for a few years, which is far away from San Diego, but we like some of the metrics there if the pricing gets to the levels that we like. We like Dallas as well.
Right.
So those are 2 markets that we've been looking at for the last close to 4 years. I do think we'll be in them at some point in some cycle. I don't know when that's going to be. The pricing, the returns have to be right, but we want to make sure that we understand everything about the market before we get in.
Good for you. Yeah, I've got quite a few assets in Dallas and some in Atlanta. I can tell you a couple of assets that I'm helping with in Atlanta that I don't have an ownership interest in are very challenged. They've had some real problems there. Evictions taking a year to go through. Yeah, be very careful in that one, I will tell you. But,
and that might lead to the opportunity for us to get in.
Yeah.
The other thing is that we want to get to about at least 1,800 units in a market. So we want to come in big because...
So you can be vertically integrated.
Yeah,
I mean, you can't have a management infrastructure if you don't have at least that many, right?
Exactly, yeah. The economies of scale of getting to that 1,800 is really important. So we want to make sure that we can get in with a good scale, and we would manage the properties from day one wherever we go, but we just want to make sure we can get to that scale and have that good efficiencies.
No, that makes perfect sense. Jeff, I really appreciate you coming down here, man. It's been a pleasure to meet you. It was super impressive what you've created, you and your father Mark, and what a treat this interview has been. Thank you for being here.
Thank you for having me. Yeah, it was great spending time together.
Likewise. So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. But see, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.